Hey everyone, welcome back for another deep dive.
Always exciting to be here.
And this time, we're tackling a topic that's, well, honestly, it's been requested a ton lately.
Yeah, this one's definitely top of mind for a lot of folks.
Dividend-paying companies.
It seems like everyone's looking for a little bit of stability in these crazy markets.
Exactly. And, it's not just about chasing those dividend checks.
Right. It's about understanding what those dividends tell us about a company.
Like, are they truly thriving or are they just trying to...
Mask some underlying problems.
Bingo. We've got 4 companies on our list today that all just announced dividend hikes.
And we're going to figure out if those hikes are a sign of strength.
Or maybe a little bit of smoke and mirrors.
Love that analogy.
So first up, we've got Gorman-Rupp, ticker symbol GRC.
They're in the pump business.
Pumps. Not exactly the most glamorous industry, right?
True, but essential. Think about it. Water systems, wastewater treatment, even oil and gas pipelines.
Okay, yeah, I guess those pumps are kind of keeping the world running.
Absolutely. And Gorman-Rupp just announced a dividend of $7.19 per share.
Which works out to a yield of about 1.93%.
And they've actually increased their dividend 6 times in the past 5 years.
So on the surface, they seem to be doing pretty well.
But remember, we can't just look at the dividend in isolation.
Right. Gotta dig deeper. What else should we be looking at?
Well, for starters, that payout ratio we talked about,
Refresh my memory on that one.
it's essentially the percentage of their earnings that they're using to pay those dividends.
Got it. So what's Gorman-Rupp's payout ratio looking like?
It's currently sitting at about 43%.
Okay, help me out here. 43%, is that good, bad, or just kind of meh?
It's actually pretty reasonable, especially for a company in a stable industry like Gorman-Rupp.
They're not exactly a high-growth tech startup, right?
Exactly. So that payout ratio suggests they have some room to maneuver.
Meaning they could potentially increase that dividend even more in the future?
Potentially, but that all depends on their future earning, right?
And speaking of earnings, you mentioned their industry is stable, but is it growing?
Ah, now you're asking the right questions.
Well, I try.
We need to look beyond Gorman-Rupp's individual performance and consider the broader trends.
So things like infrastructure spending, environmental regulations, maybe even new technologies that could disrupt their market.
Exactly. All those factors will play a role in determining if Gorman-Rupp's dividend is truly sustainable in the long run.
Okay, so Gorman-Rupp, the pump folks, paying a decent dividend, but we need to investigate if their industry is a stagnant pond or a flowing river.
Love that analogy. Now, ready for some denim?
Bring on the jeans. We're talking Kontoor Brands, ticker symbol KTB.
The folks behind Wrangler and Lee jeans.
Brands that everyone knows, but here's the question. Is denim a good bet when the economy is doing the jitterbug?
Yeah, people tend to cut back on discretionary spending during tough times.
And clothes are often the first to go.
Exactly. So let's look at Kontoor's dividend.
They just declared a 52 cents per share dividend, which gives us a yield of 2.60%.
And they've raised it 4 times in the past 5 years.
Not too shabby. What about their payout ratio?
It's actually quite similar to Gorman-Rupp, around 42%.
Interesting. Similar payout ratios, but completely different industries.
Makes you wonder if a payout ratio that's healthy for a pump manufacturer is also healthy for an apparel company, right?
Especially for heading into a recession.
Exactly. So we need to dig deeper into Kontoor's brand positioning.
Are Wrangler and Lee considered those value brands that people flock to when they're tightening their belts? Or are they seen as more premium, more likely to take a hit?
That's the million-dollar question. We also need to look at their overall strategy.
Are they cutting costs, innovating their product lines, maybe even exploring new markets?
Those are all clues that will tell us if their dividend hike is a sign of true confidence or just wishful thinking.
Okay, so we've got pumps and jeans covered.
Ready to move on to something a little more, shall we say, niche.
Hit me with it.
West Pharmaceutical Services, ticker symbol WST.
West Pharmaceutical Services, what are they?
They're in the business of drug delivery systems.
Like vials and syringes and stuff.
Exactly. Think vaccines, injections, all those things that are super crucial in healthcare.
Okay, not something most people think about, but yeah, definitely essential.
And here's where it gets interesting. They just announced a $0.21 per share dividend.
Yield of 0.26%. Okay, not huge, but you said they've been steadily increasing it.
For the past 5 years, yep. But now, buckle up for their payout ratio.
I'm ready. Hit me with it.
A mere 12%.
Wait, 12%? That's incredibly low. They're barely touching their earnings to pay that dividend.
Exactly. And that raises a big question.
Like, are they hiding something?
Well, it could be a red flag, but it could also be a giant green flag.
Okay, now I'm really confused.
They're in a growing industry. They have tons of room to increase that dividend, yet they're holding back.
So the question is why?
Are they funneling those profits into some groundbreaking research and development?
Maybe they're planning a major acquisition. Or are they just super cautious about the future?
Those are all possibilities we need to explore.
All right, so we've got a mystery on our hands with West Pharmaceutical Services.
They're sitting on a mountain of cash, steadily raising their dividend, but something's making them hold back.
Intriguing. Now, on to our last company.
And this one's a real wild card.
Oh, I love wild cards. Let's hear it.
Standex International, ticker symbol SXI.
Standex International. What do they make?
Well, that's the thing. They make a lot of things.
Like what?
We're talking everything from food service equipment to engraving machines to hydraulic components.
Whoa, they're all over the place. That's got to make them tough to analyze.
It's a challenge, but it also gives us a chance to understand how diversification impacts a company's dividend strategy.
So what's their dividend looking like?
They just declared a $1.32 per share dividend.
Yield of 0.68%. 6 dividend increases in the past 5 years. Okay, consistent. I like it.
And their payout ratio.
Don't tell me another low one.
Yep, just 17%.
Wow, okay. So West Pharmaceutical and Standex, these diversified companies, both choosing to keep those payout ratios super low.
Is it a coincidence? Or is there something about being spread across multiple industries that makes them more cautious?
Maybe they like having that extra cushion, just in case one sector takes a hit.
That's one possibility.
So with Standex, we've got a lot to unpack. The pros and cons of that diverse portfolio, their track record in each of those industries.
And ultimately, whether their dividend signals genuine confidence or just a desire to play it safe.
Sounds like we've got our work cut out for us.
Absolutely.
All right, listeners, we've laid out the initial clues for our 4 companies.
Each with its own unique dividend profile.
But I don't know about you, but I'm already itching to dig even deeper.
And that's exactly what we're going to do next. But before we get into the nitty-gritty of each company, I think it's helpful to take a step back.
Okay.
And talk about how you, the listener, can approach dividend analysis.
Ooh, yes. Teach us the ways.
We can all be dividend detectives.
I like that.
So where do we even start?
Yeah, where do we start? I mean, I see those dividend yields.
Right.
But what else should I be looking at?
Well, it all starts with those financial statements.
Oof, the dreaded financial statements.
I know they can be a bit intimidating, but trust me.
Okay.
They don't have to be.
Okay, I'm listening.
First, focus on the income statement and the cash flow statement.
Those are the 2 big ones.
Yeah, those are the ones that are really going to give you the insights you need.
Okay, so what am I looking for in those statements?
Start with the company's revenue and earnings trends.
So basically, are they making money and are they making more of it each year?
Exactly. You want to see consistent growth or at least stability.
Right. Because if a company is struggling to bring in money...
They probably shouldn't be throwing it around in dividends.
Makes sense.
What else?
Next, focus on their cash flow.
Okay.
Specifically, free cash flow.
Free cash flow, what is that exactly?
It's the cash they have left over after covering all their essential expenses.
So like their fun money. Exactly. And the more free cash flow they have...
the more likely they are to share it with us investors through those sweet dividends.
Right. But here's where it gets interesting.
Okay, I'm intrigued.
A company with a ton of free cash flow might choose to hoard it.
Hoard it? Why would they do that?
Well, maybe they're planning a big acquisition.
Ah, so they're saving up for something big.
Exactly. Or maybe they're investing in a new game-changing project.
So a small dividend doesn't necessarily mean a company is weak.
Not at all. It could mean they're playing the long game.
Okay, I like that perspective.
No, another crucial factor to consider is their debt levels.
Ah, yes, debt. The 4-letter word of finance.
High debt can really eat away at that free cash flow.
Because they're using it to make those interest payments.
Exactly, leaving less money for dividends.
So even if a company looks profitable on paper,
a mountain of debt could be lurking beneath the surface.
Got it. So how do we spot that in their financials?
Look at their debt-to-equity ratio.
Okay,
Yeah.
And that tells me.
How much debt they're using compared to shareholder equity.
Got it. So a high ratio means...
they might be a little bit too reliant on debt.
and their dividend could be at risk.
Exactly. So we've got Revenue, earnings, free cash flow, and debt levels.
Those are our 4 key metrics.
Now, remember how we talked about dividend decisions not just being about the numbers?
Right, it's also about strategy.
We need to get inside the minds of these CEOs.
Ooh, mind reading time.
Well, not quite, but we can look for clues in their communications.
So where do we find these clues?
Check out their annual reports,
Right.
investor presentations,
Mm-hmm.
and those often overlooked earnings calls.
So we're playing detective again.
We're trying to understand their motivations, their long-term vision.
So what are we listening for?
What are their stated priorities? How do they talk about their industry?
Oh,
Do they see themselves as dividend champions?
like it's a core part of their identity?
Or are they more focused on aggressive growth and reinvesting those profits back into the business?
Got it. So it's all about understanding their mindset, their overall philosophy.
Exactly. And these qualitative insights can be just as important as those hard numbers.
Love it. It's like we're putting together a puzzle.
Exactly.
Okay, so I feel like I'm getting the hang of this dividend detective work.
You're doing great.
But before we apply all this to our 4 companies,
Yeah.
any other red flags we should be aware of?
Yes, there's one big one you never want to forget.
Lay it on me.
Dividends are not guaranteed.
Wait, what? But I thought those dividend aristocrats.
Even those companies with decades of consistent increases can hit a rough patch.
Oh, man.
So always do your due diligence.
Okay.
Understand the company's financial position, their industry, and most importantly, their long-term prospects.
Don't let that dividend yield blind me to the bigger picture.
Exactly.
Okay, that's a really important reminder.
All right, so now I think we're ready to apply all this knowledge to our 4 companies.
Yes, let's put those detective hats back on.
Let's see if we can crack these cases wide open.
Starting with Gorman-Rupp the pump people.
Remember, their payout ratio is reasonable.
Yep, 43%.
Yeah. But is their industry a growth engine or a slow leak?
That's the million-dollar question.
Well, Gorman-Rupp focuses on pumps for water, wastewater, and even oil and gas pipelines.
So those are essential industries.
Absolutely. But their growth is often tied to larger economic trends.
So we need to look beyond Gorman-Rupp themselves.
Exactly. Think about things like government spending on infrastructure projects.
Oh, right. If governments are cutting back, that could hurt their business.
Even if they're a well-managed company.
So their dividend might not be so secure if the whole industry takes a hit.
Exactly. Now, how about Kontoor Brands? Those denim giants.
Yeah, we were talking about their brand positioning.
Are Wrangler and Lee those value brands that people flock to when times are tough?
How do we even figure that out?
Well, it's time to dig into those earnings calls,
Okay.
marketing campaigns,
Mm-hmm.
even their social media presence.
So we're looking for clues in how they talk about themselves and their products.
Exactly. Are they emphasizing durability and affordability?
Or are they going for a more high-fashion premium vibe?
Exactly. And we also need to consider their geographic reach.
Oh, right. Like,
Yeah.
are they concentrated in areas that are particularly vulnerable to recessions?
Or are they spread out across different regions?
Okay, so Kontoor's dividend sustainability depends not just on their financials.
But also on their strategy and how they adapt to changing consumer preferences.
And, of course, the overall economy.
All right, now remember West Pharmaceutical Services?
The one with the crazy low payout ratio.
Yep, 12%. So let's see if we can unravel their strategy.
Yes. I'm dying to know what they're up to.
Remember, they're in a growing industry.
Healthcare. Right.
But what are they doing with all that extra cash?
Yeah, are they really investing heavily in R&D like we thought?
Well, if we look at their annual reports and recent acquisitions, we see a fascinating trend.
Ooh, what is it?
They've been aggressively expanding into specialized drug delivery systems,
Specialized, like what kind of systems?
specifically for things like biologics and injectable therapies.
Ah, so they're not just making those basic vials and syringes anymore.
They're moving into more high-tech, high-margin products.
So they're betting on the future of medicine.
Exactly. And that explains their low payout ratio.
They're using those profits to fund all this expansion and innovation.
So their seemingly conservative dividend is actually a sign of ambition.
Wow. I'm impressed. They're not just riding the current healthcare wave.
They're trying to be leaders in the next generation of drug delivery.
Okay, West Pharmaceutical is officially my dark horse pick.
I like it. Now, how about our final company, Standex International?
The diversification champion?
Remember how we talked about diversified companies being more cautious with their dividends?
Yeah, but diversification can be a double-edged sword.
Exactly. It can offer stability.
But it also makes it harder to analyze their true strengths and weaknesses.
So how do we approach a company like Standex?
Yeah, any tips?
Well, we need to break down their business into its core segments.
Okay, so instead of looking at the whole company,
We look at each piece individually.
got it. So what are we looking for in each segment?
We want to know what their key revenue drivers are.
Okay, so what's bringing in the most money?
And then we want to see which industries are thriving and which are lagging behind.
So their dividend might look good on paper.
But if it's only supported by one or two strong performers...
It could be more vulnerable than we think.
Exactly. We also need to consider potential synergies.
Synergies.
Like, do those different businesses complement each other?
Ah, I see. So are they creating unique advantages by being diversified?
Or are they just a random collection of companies?
Okay, so with Standex, we need to really dissect their portfolio.
Understand how those different pieces fit together.
And ultimately, whether their dividend strategy makes sense.
Given their overall business strategy.
This is starting to feel less like a simple dividend analysis.
Right.
And more like a full-blown corporate strategy session.
That's the beauty of it. Dividend decisions are never made in a vacuum.
They're tied to the company's financial health, their strategic direction.
And their outlook on the future.
Okay, I feel like we've leveled up our investing skills today.
I think so too.
But I have one more question for you.
Okay.
If you were managing a company right now, what would your dividend strategy be?
That's the million-dollar question, isn't it?
It is.
There's no easy answer.
Okay.
But I can tell you the principles that would guide my decisions.
Okay. One all.
First and foremost, financial prudence.
Okay, so being responsible with the money.
Making sure we have a strong balance sheet, ample free cash flow,
Okay.
and manageable debt levels.
So dividends should be paid from sustainable earnings.
Not from risky borrowing.
Got it.
Yeah.
What else would you consider?
Well, growth potential.
Ah, okay.
If the company's in a high-growth industry with lots of opportunities, I might lean towards reinvesting those earnings back into the business.
So you'd prioritize growth over immediate dividends.
In that scenario, yes.
Makes sense. But what if the company is in a more mature industry?
Then returning a larger portion of those earnings to shareholders through dividends.
That'd be the better move.
Exactly.
So it's all about finding that balance.
Between rewarding shareholders and investing in the future.
And it sounds like there's no one-size-fits-all approach.
Every company is different.
This has been so insightful.
I'm glad you're finding it helpful.
But I feel like we've only just scratched the surface.
I know there's so much more we could talk about.
We could do a whole series on dividends.
We definitely could.
But for now, we have one more company to analyze.
And this one presents a truly unique case study.
Oh, now you've got me really curious.
Get ready for a deep dive into a company that's both a household name and a walking contradiction.
Okay, so this mystery company, the one with the unique dividend situation.
Get ready for this one.
Lay it on me.
It's Altria Group, ticker symbol MO.
Altria Group. Wait a minute, isn't that
The tobacco giant?
the maker of Marlboro cigarettes?
The one and only.
Okay, so right off the bat, we've got to acknowledge the,
The elephant in the room.
yeah, it's a controversial industry, to say the least.
Declining smoking rates, increased regulation, and of course...
The ethical considerations.
Absolutely. But putting all that aside for a moment,
Okay.
Altria's dividend strategy is fascinating.
Really? How so?
They've been paying and increasing their dividend for decades.
Even though people are smoking less.
Even with all the challenges they're facing.
So how have they managed to do that?
That's the million-dollar question. And
Wait.
what does it tell us about their future?
All right, I'm hooked. Give me the number.
So Altria just announced a quarterly dividend of $7.94 per share.
Okay, and that gives them a yield of,
Wait for it,
I'm on the edge of my seat.
8.99%.
Whoa, almost 9%. That's got to be one of the highest out there.
It's definitely up there, especially for a company of their size.
But we know better than to just chase yield, right?
Right. High yield doesn't always mean a good investment.
What about their payout ratio?
It's currently sitting around 78%. It's currently sitting around 78%.
Okay, so higher than the other companies we've looked at.
But not necessarily a deal breaker on its own.
So they're using a big chunk of their earnings to pay that dividend.
They are.
But how is that sustainable if their main product is literally facing a decline in popularity?
Well, to understand their strategy, we need to look beyond cigarettes.
Beyond cigarettes, like what?
They've been investing heavily in other things.
Like what?
E-cigarettes,
Okay.
heated tobacco products, even cannabis.
Wow, they're really trying to diversify.
They are.
But is it enough?
That's the billion-dollar bet, right?
I mean, those new markets are pretty risky too.
Very true. Constantly evolving regulations, fierce competition.
So it's not a sure thing.
Not at all.
So how do we make sense of all this? How do we analyze Altria's dividend?
Well, I think there are a couple of layers to consider.
Okay, like what?
First, their commitment to the dividend itself.
Okay.
They've increased it for over 50 consecutive years.
50 years. That's incredible.
It shows they're serious about returning value to shareholders.
So they're not going to give up that streak easily.
Exactly. But on the other hand, they're under pressure to adapt.
Their core business is shrinking.
Right? So they need those new ventures to succeed.
And that high dividend could be a way to keep investors happy in the meantime.
It could be.
So it's a balancing act.
Between short-term rewards and long-term risks.
Okay, so let's say I'm an investor and I'm tempted by that 9% yield. What advice would you give me?
I'd say proceed with caution.
Don't just jump in blindly.
Exactly. Do your research. Look beyond that dividend.
Understand the company, their strategy, their industry.
Altria is a good reminder that even the most established companies can face disruption.
And their dividend shouldn't be the only factor in your decision.
Exactly.
Well, I don't know about you, but I feel like we've covered a lot of ground today.
We've been from pumps to jeans to pharmaceuticals to tobacco.
It's been a wild ride. But I think we've learned some valuable lessons along the way.
Definitely.
And for our listeners out there, remember, dividends are just one piece of the puzzle.
Don't get fixated on chasing those yields.
Do your research understand the companies you're investing in?
Think long-term.
Be a dividend detective.
Exactly.
All right, that's all the time we have for today's deep dive.
Thanks for having me.
It's always a pleasure. And for our listeners out there, as always,
Happy investing.
until next time, keep exploring.